we may be getting near something of a bottom. I'm sure you saw gold today, right? It was up $33 or something like that. I'm not looking at the screen right now. But when folks are scared, when the folks at home are scared, they go to utilities, they go to dividend payers. When they're really, really scared, they go to gold. They went to gold today. So I'm thinking with the financials reporting tomorrow, a lot of these corporations will be allowed to repurchase their own shares again. That's a big part of the buy side. That's coming up within the next week or two. We'll start seeing that. It's $1 trillion, mind you, aggregate the whole marketplace. I think this was a chance to buy, and I actually was buying. I'll give you a list of names if you like.
Interesting. I do want to get to that in a second, but just to understand what rattles, I guess, investors or smart guys like you, or could, is that when you compete with the relative safety of a fixed income investment, like a 10-year note, you get 3%, it's guaranteed by Uncle Sam. It makes a compelling case in times of volatile markets to park your cash there. Are you seeing a lot of people do that, or is it your sense that this is seen as like a passing phenomenon?
Well, Neil, you know, I have I'm high touch with the public. I receive a lot of emails, and I answer all my emails. And I am seeing people ask those questions. I don't really know if they're acting. I try to give some kind of, I don't know, not so expensive advice on how to hedge your positions if people are interested in staying long their positions. But people are definitely nervous, and I am being asked if I know a good gold broker by some people. So there are people thinking along those lines.
So
I do know.
You did mention that you're sort of sniffing around at some buys. Where would you be going?
All right, but just a few minutes before we came on the air, I bought some Amazon. It's trading at very low levels. I bought some Salesforce, I bought some Adobe, I bought some General Dynamics, and I bought some Apple. I made the mistake a while back of getting out of Apple in the high 180s. Now, I provided some revenue by selling some put options along the way, but that doesn't provide the same kind of return as an equity stake. So on this dip, I started buying Apple yesterday, and I continued right through today.
All right, so by buying on the dip, convinced that this could be short-lived.
Listen, we never know, right?
Right.
I mean, I may be eating canned food out of the gutter tomorrow, but I'm fully prepared to do that based on the knowledge that I have acquired over almost a 40-year career and my ability to survive these things. I am sensing that the market is feeling around for a bottom. Now, you may have me on tomorrow and I'm singing a different tune, but that's how it felt late in the day today, even though the market was headed lower.
All right, buddy. Thank you very, very much. And I call him the Sarge, and he is good at what he does. Stephen Guilfoyle speaks his mind, very frank. And so does the President of the United States when it comes to pointing the finger here. He said, don't look to me. Look at the Federal Reserve. Look at the local policies here that have been pushing interest rates up and pushing us to the edge. Third time in as many days the president has targeted the entire Federal Reserve for making this day come. John Roberts at the White House with more on that. Hey, John.
Hey, good afternoon to you, Neil. First of all, the president says that he doesn't believe there's much to worry about here. He says the economy is still strong. The swoon in the markets is probably only a temporary thing. And even though the markets are down, he says they're still up 40% from where they were when the president was first elected. So he thinks that this is just a bull market correction, a temporary dip in the Dow. He does, though, as you were mentioning, fault the Federal Reserve for hiking interest rates faster than he would like or would have done himself if he were in a position to do so. The Fed's hiked rates 3 times this year, likely one more hike coming before the end of the year. Last night in Erie, Pennsylvania, the president came off of Air Force One and said the Fed has gone crazy. Today he suggested he could do a better job. Listen here.
Fed is out of control. I think what they're doing is wrong. I think the Fed is far too stringent and they're making a mistake and it's not right. And it's, despite that, we're doing very well, but it's not necessary, in my opinion, and I think I know about it better than they do.
That session this morning, which was actually to sign the Save Our Seas Act, the president was asked if he plans to fire Fed Chairman Jerome Powell. The president said no, he has no plans to do that, but he does think that Powell is moving far too quickly on interest rate hikes. Neil?
All right, John Roberts at the White House. Thank you very much. If you're noticing a difference in this president versus others in terms of market crises, you're right. He has said what other maybe presidents have thought when it came to interest rates going up in the middle of a very dicey economy, or one that they hope to see moving along. But the contrast here between this president and, let's say, Ronald Reagan and the '87 crash is noteworthy. Take a look.
It's a correction that I think is caused by the Federal Reserve. I think the Fed is out of control. I think what they're doing is wrong.
All the other things I've told you about the economy are as solid as I've told you. So, no, I have no more knowledge of why it took place than you have.
All right. That, of course, was Ronald Reagan right after the 1987 stock market crash on October 19th, where he didn't assign much value to one day's move in the market. A few months later, he was proven right. The market was right back to those old-time levels. The read from that and the risk of going after the Federal Reserve, if there is one, let's talk to former White House Press Secretary Ari Fleischer, Market Watch's Larry Trevor, and Catherine Rooney Vera. Catherine, to you on the risk this president is taking because he is countering his own views said during the 2016 presidential campaign when he bemoaned that the Federal Reserve was keeping rates artificially low, that it was rigging the economy, rigging the markets, and that they had to get back to an equilibrium. Now we are getting back to that equilibrium, and he doesn't like it. He's president.
Right, that's right, Neil. But I would say one thing. I think this is going to be short-term, so the president doesn't have to rail too much against the Federal Reserve. The Fed doesn't have to hike more than 3 times next year, Neil. We saw inflation come out this morning, Neil, and it came below expectations and a deceleration from last month. So I don't see the impetus to go more aggressively than the Fed, by the way, is already discounted into the market pricing. So 3 times next year, I think, is the max. I expect earnings season, which starts tomorrow, Neil, to be phenomenal. 20% year-over-year expansion in earnings is what I'm expecting. And let's face it, economic growth is strong. So I'm taking this, Neil, as an opportunity to buy, and that's what I'm recommending to my clients.
All right. You know, Larry, the economy is strong. There's no doubt about that. And that's why rates are going up. And that's why there's confusion in the marketplace. No matter what the president says, you could argue it's his very stewardship of this strong economy that's both his best friend and right now his worst enemy, right?
Yeah, no, exactly. And let's keep in mind that global growth, we're entering the 8th quarter of consecutive above-trend growth. You know, forget about all the noise. I mean, we're still traveling above trend for global growth. And consider this, 3 years ago, 3-month paper was yielding 0. Today, it's 227. I think that's when it closed. The S&P 500 dividend yield has gone down. Now it's like it's yielding about 45 basis points less than a 3-month bill. So people are saying, well, maybe they're going to diversify more out of the stock market. But the bottom line is, it's global growth that at the end of the day, you know, trumps everything else, no pun intended. And I think if we continue to wait the next couple of weeks, more GDP numbers around the world come in, we'll see that we continue running at trend, and it makes sense to be well diversified in an equity portfolio.
You know, all right,
Neil,
sure, go ahead, Kevin. Go ahead. I'm sorry.
Yeah.
Neil, I have to jump in here because it's just fascinating to me that the IMF downgraded just yesterday or the day before their global growth forecast under the supposition of an if President Trump executes all his proposed tariffs, then global growth. But they actually downgraded the forecast. Now, this is an entity, along with the Fed, that has historically missed on their growth targets, underestimating the negative impact of high regulation, suffocating regulation, and high taxes under past years and past presidents, and overestimating growth and making the same mistake on the flip side now.
Yeah, and I found a little rich of Christine Lagarde, the managing director of the IMF, to cite the trade situation as a slowdown in global growth when that was well entrenched with higher rates and very frozen economies in the Eurozone. That was a bit rich. But Ari, I did want to talk about the danger you see in speaking what you're thinking. You know, every president probably of Democrat, Republican has bemoaned a Federal Reserve that hikes interest rates because, you know, they don't like it. But this president goes on record as saying, you know, this is a big problem with me, and even volunteers that I'm not going to fire the guy, but I'm not happy. Talking about Jerome Powell, the chairman of the Federal Reserve, with what he's doing. What is the danger of that?
I see no danger. You know, Washington is a very institutional, historical, traditional town, and especially the way government runs, and the White House. I was told at the White House there are 2 issues that we do not comment on, and one was interest rates, it's the purview of the Fed, and the second is the dollar, strong or weak. We just don't talk about it at the White House. Well, and I asked, why not? And I was told, because that's just the way it's always been done. Well, that's not necessarily the right reason to do something. So when President Trump comes along, as he always does, he breaks traditions because he is not bound by them. There is an upside to it. And the upside is he's blunt, he's plain-spoken, he's authentic, and he's telling the truth here, I think.
All right, you might be right, but Larry, my worry with that, and I can agree, you know, speak your mind, but the danger is all of a sudden, whatever the Federal Reserve does is going to be looked under the political context, right?
If you're asking me, Congress has always done that to the president.
Larry?
Go ahead, Larry.
Yeah, exactly. Congress has always done that, and the danger right now is that we have a December rate hike already priced in. If we don't get the inflation that is needed, which we're not right now, real policy rates are going to be much higher than what they actually are. So they're going to have a lot of questions, and you can't fight the Fed, and even the president can't fight the Feds.
All right,
so
Catherine, what do you think of that? Is there a danger with putting them on the spot? Because no matter what they do now, they're going to look at, they eased up on hiking because they're afraid, or they went aggressively because they wanted to show they weren't afraid.
Neil, this is a completely independent Fed. What I would say is look at the G20 next month. That's going to be key. The president is meeting with the Chinese premier, and I think that's going to be key for going forward. I bet that China has concessions on trade, and we avoid this full-fledged trade war that everyone's so fearful about.
Yeah, you avoid that. All of a sudden, this gets reversed very, very quickly. Guys, thank you very much. I apologize for the interruption. It was a little breaking news. Bottom line here, we had a big hit right now. The NASDAQ is in correction territory, having fallen 10% or more from its highs. The other two averages are just a couple of percentage points away. What could push them over the top after this? The wince at the prospect that rates were going to start going up near the end of his term to sort of balance things out, return to an equilibrium, or what? And how did he express it?
I wasn't there I was in the first term, so nobody thought the rates were going to go up when I was there.
And we
didn't melt down. I think there's a long history of, in private, like you say, presidents and administrations wincing, why is the Fed doing this? I guess I don't understand. I guess I do understand, but I'm puzzled by why the president would kind of publicly come out and attack the Fed and the Fed chair. He appointed this guy. Did they not talk about how do they see the economy? I mean, it was very clear that this was on the Fed's to-do list, and has been for multiple years. They've been saying as the economy improves, they're going to try to raise the rate. So I don't see why he's now saying they've gone crazy.
Well, maybe because of the market reaction, to your point. And I'm wondering, when we talk about returning to equilibrium or sort of a more historically acceptable range for, let's say, federal funds, the overnight bank lending rate, I guess we're at around 2.5%, Austin. The argument is you have to take it up to 5% just to get back to historical norms. What the market seem to be saying is there's no end in sight here. There's a fear that this is going to go up, and that's what's panicking and leaving the president out of it. What do you think?
Maybe. I think there's a bigger component of this fear that's about spiraling trade war with China. And so that's why I said maybe I do understand what the president's trying to do, which is he's trying to take the focus of the market drop off of his actions and try to put it on, oh, no, it's the Fed and somebody else created this market drop. I don't know if he'll be able to do that. I mean, if I'm right that trade war component is some part of the thing that's freaking out investors and businesses, that's going to become clear over the next 3 weeks, month, what have you. And I don't think it will be that hard to blame someone else.
Well, there might be something to that, obviously, given the fact that China, we talk about our own market that is still up on the year, in fact, up significantly since this bull market began, the historic long bull market that began under Barack Obama, continued under this president. I'm wondering what you make of the length of that being questioned, and that's what's concerning a lot of investors. That I know bull markets don't die of old age, but they can get badly wounded and sort of picked apart on a variety of other developments. And these other developments, like the trade war coming into play, or other factors like Italy falling out of bed, emerging markets are in trouble, right?
Right. Look, there's plenty of things. If you want to give yourself heartburn, you can always find a way to give yourself heartburn. Bull markets don't die of old age, but they don't last forever either.
That's true.
And usually the kinds of things that point to the end of these big bull markets are various ratios get out of whack by historical standards, that the prices get real high compared to, say, the earnings. And then that makes people especially paranoid if the earnings start to go down because of trade war, because of something. If the Fed raised rates too fast and inverted the yield curve. Again, there are historical indicators that do not bode well for the medium run returns in the stock market, and some of those are warning yellow lights. So I think there are people in the administration who are nervous about that, But, you know, you live by the sword, you die by the sword. You remember when the stock market was going up and the president wanted to get out and claim credit for it? And it was on this program I told you, I always advise President Obama not to try to take credit for the stock market going up, because the stock market goes down too, and then they come point it.
Yeah, Ronald Reagan apparently had the same view. But this could be just a phenomenon that is short-lived, and we go back to that. We don't know.
Yeah, and I hope it is. I hope that's what it is.
Austin, thank you very, very much. That inverted yield curve.
Great to see you.
Thank you, my friend. That inverted yield curve to which he spoke is about the narrowing gap between short and long-term interest rates. It gets worrisome when short-term rates actually go higher than longer-term rates. A recession every time. That's a big worry. Hard to say we're even remotely there yet. I just put that out there. John Roberts, meanwhile, at the White House on indications, maybe the president is going to entertain some questions from the Mueller folks. What's going on there?
Yet another story to report this afternoon, Neil. You got to be a utility player to do this job. You know, we've been reporting for weeks that the president's attorneys have been negotiating with the special counsel's office to provide written answers to written questions by the president that deal only with Russia and collusion. Nothing about his Article 2 powers, which would go to obstruction of justice issues. You know, I'm being told that as a matter of course, his attorneys have been sort of whittling down the number of questions to see which ones would be acceptable, which ones wouldn't be acceptable. Along with that, you prepare background materials so that the president has got a full knowledge of everything that's gone on at the White House when he answers those questions. And I assume that he would probably write those questions along with the help of his attorneys. But it doesn't look like anything is imminent at this point. I was told by Rudy Giuliani last week that it's possible that this could happen before the midterm elections if they come to an agreement on questions, but there's not even an agreement in place yet with the special counsel's office. So it just seems like, you know, the usual background work is going on, and if they do reach an agreement with the special counsel's office, they'll be able to jump on this fairly quickly. Neil?
All right, John, if you would work a little harder, we'd appreciate that, young man. All right.
I'll try. I'm such a slacker.
Oh, my. Holy cow. All right, John Roberts at the White House. We're going to have more from the Florida Panhandle. They dodged a bullet, but, man, they didn't escape a lot of mess. After this.
UX50, and it's
The economy's looking up and interest rates are going up. So is that such a bad thing? Let's go to Fox Business's Hillary Vaughn with more on that. Hey, Hillary.
Hey, Neil. Well, we talked to a lot of people today that say this big market drop is concerning, but they're taking it in stride. A few people told me they're keeping their eyes on their 401ks, but they aren't freaking out just yet.
It's always scary when you see the market drop 8 times.
I looked at the trend of my stocks last night, and it has been extremely volatile. It's not a great feeling.
It's not as worrisome as most people, again, are saying. It's a very natural stepping stone for rates to increase.
Some people I talked to are worried less about stocks and more about interest rates rising and how that's hurting both young people and retirees.
The rising mortgage rates just make it really tough on anyone trying to break into the housing market.
Just when we got unemployment down to under 3%, and now all of a sudden growth will stop because investors have lost faith, we should all be concerned.
So, Neil, across the board, people we talked to say they're watching and waiting to see what happens, but they aren't ready to make any major money moves just yet. Neil?
All right, Hillary, thank you very much. You know, rising rates can be a lot of good news to some folks. Let's go to Deirdre Bolton on that. Hey, Deirdre.
Looking for silver linings here, Neil. So here's one: savers benefit. That's the one thing we can talk about. Consumers should be able to get higher savings rates in their savings accounts with banks they normally use. And for some reason, if those rates are not competitive, well, there's now online banking options, and some online-only banks have pretty generous terms. CDs, certificates of deposit, they will offer higher rates. And that's a pretty safe place to put money. So a lot of investors think that CDs are kind of like the next best thing to cash. And for people close to retirement or in retirement, it's a pretty popular product. When rates move higher, consumers can get higher, that is, annual percentage yield. So I looked online. I found some yields on 5-year CDs exceeding 3% with a minimum deposit. In general, rising rates also a sign that the economy is doing pretty well. So in theory, that indicates that more people can get pay increases at some point. Obviously, that's a little bit more of a fluid reason than the savings rates or the rates on CDs. For shareholders, Neil, lastly, who own bank stocks, they may see a long-term boost in value because usually banks do pretty well in a higher rate environment. And we know tomorrow we're going to be hearing from 4 key banks: JP Morgan Chase, Wells Fargo, Citigroup, PNC Financial. Analysts are going to be watching for details about loan growth. That's one of the key metrics: deposit costs and net interest margins. Neil, back to you.
All right. Thank you very, very much, Deirdre. All right. It's about, 1,400 points in 2 days. It's about 5% of the Dow Jones Industrials. Nothing like 1987, where in 1 day we lost 508 points, but that represented a quarter of the wealth in the Dow. That was then some perspective that could be timely and important now. Minimize the pain you've been feeling in your portfolio, but we are down about 6.6% from the high for the Dow Jones Industrials. I want to show you something else on which we're coming up on an anniversary here. When the Dow lost almost a quarter of its value in a single trading day. Secret Securities founder Ted Weisberg remembers both, has a bit of perspective on both. And Ted, thank you for taking the time. People forget that, but they worry that things here are going to escalate. Do you see it escalating?
Well, I think we're at a bit of an inflection point now, Neil, vis-a-vis interest rates and perhaps the rhetoric and the real the negative downdraft from tariffs and future tariffs, especially with China. So there are things to be nervous about, and the markets were trading at all-time highs. But I think the culprit at the moment is interest rates. The Fed's done a pretty good job at telegraphing that they were going to raise rates for the last 18 to 24 months. But reality is 2 or 3% on government bonds is pretty compelling when you don't want to have any risk.
Yeah, and that's what can draw people in. Do you think that continues then? Because if they are drawn in increasingly to the safety of a government security, this could continue for stocks, right?
Well, it could. Let's not forget that it wasn't that long ago that we had 7 or 8 years of zero interest rates.
You're absolutely right.
Where the equity markets became the default mechanism for an asset class, and people that wanted some juice from their assets gravitated to the equity markets. But if you're retired and you don't want the risk, clearly if you can get 2 or 3% on your money versus taking some risk in the stock market, the short thing is very compelling. So you do have folks taking money off the table. And then, of course, we have the perennial programs which have hit in, and the downside's always more severe than the upside. They always go down.
Right about that. How many of these have you and I talked about that very subject, my friend? What do you look for in the near term? I know we're going to start getting bank earnings tomorrow. Right. They could probably, help the market digest good news that's happening on that front. What do you think?
Well, I think yes. I mean, tomorrow we enter the third quarter earnings reporting period full time with the big money, some of the big money center banks. Hopefully, as in the past, we're going to get more good news and bad news from corporate America, and certainly that should help. But then, right behind that, we have the midterm elections, which is another huge unknown, depending on how they go. So we've got a 1-2 punch we have to deal with. The first one should be positive. The second one is a big question mark. So I think it's going to be choppy waters probably for the next 2 or 3 weeks. But hopefully we'll get a positive tone out of the earnings period, which should carry us right into the midterm elections.
We shall see. Ted, it's always a pleasure. We got to stop meeting like this when there's a crisis now, all right?
Yeah, thank you.
Be well, my friend. Ted Weisberg. Some perspective is everything here. Just be reminded by what Ronald Reagan was like right after stocks tumbled on that fateful day in 1987. He argued that stocks go up, stocks go down, that really there's nothing more he could explain, just that he was optimistic about the fundamentals, the economy, and the markets, and America. He was proven right then. I suspect he'll be proven right now.